In 2019, you exempted more short-term trading holdings from the rules, so banks could take on a little more risk. Now, that weakened the rule. Then in 2020, you eased up the rules to let banks invest more of their assets in high-risk private equity and hedge funds. So the Volcker rule got weaker again. So let me ask, Mr. Chairman, during the past 4 years, has the Fed done anything to make the Volcker rule stronger and limit risky trading for the largest banks?
I think by clarifying it, we made it more effective at what it's supposed to do, which is just what you said.
Well, I have to say, it's whether or not you did anything to make it stronger, not just whether or not you made it clearer. It's whether or not you made it stronger or harder for banks to engage in speculative trading. So I'm taking it that the answer here is no. I've highlighted 2 examples of weakening regulations, but there are a whole lot more. Reducing capital requirements, easing liquidity requirements, shrinking margin requirements, scaling back on supervision, weakening the stress test. It's a long list, and I realize that you think these are good changes, but I'm trying to look at this from a regulatory perspective. Is the chairman of the Federal Reserve making banking rules stronger or weaker? So tell me, Mr. Chairman, is there a big rule change that I missed? Can you name a change that strengthened the rules and made the actual rules tougher?
Well, let me say we did not weaken capital requirements for the largest banks, and I actively resisted any move in that direction. And in fact, the stress capital buffer, which we implemented quite recently after years of consideration, raises capital standards for the largest banks. By the way, stress tests, they're really bound by the stress tests. We maintained the very high stringency of the stress tests through this period. So,
but what I was asking about anything tougher, look, what I'm looking for is that the Fed's record over the past 4 years, I see one move after another to weaken regulation over Wall Street banks. And that worries me. There's no doubt that the banks are stronger today than they were when they crashed the economy in 2008, but that's the wrong standard. The question is whether or not they are strong enough to withstand the next crisis, and whether the Fed is tough enough to protect the American economy and the American taxpayer. In 2020, the giant banks that are the beneficiary of these weakened rules made it through the crisis. But the researchers from the Minneapolis Fed found that the banks would have faced up to $300 billion in losses if not for fiscal stimulus from the government. In other words, the current Fed rules were not strong enough for the banks to withstand the pandemic without, once again, calling on American taxpayers to back them up. And that's the heart of my concern. I understand that the next crisis may feel far away, but like the pandemic, it may come at us fast and from an unexpected direction. It is the job of the Federal Reserve, and specifically the job of the chair of the Federal Reserve, to use the regulatory tools that Congress has created in order to make sure that banks remain strong and that taxpayers will never be called on again for a bailout.